In this course, we begin with variance analysis. That is, comparing actual results either to budgeted amounts or to standards. We do this in order to identify deviations and causes, which will help us when controlling operations or making decisions. Now, you should know in this section that the calculation questions are weighted heavier than the definition type questions. Now we're talking about measuring performance against goals. What goals? Well, those are the numbers that were established in the master budget. And we're going to evaluate revenue and costs and profits against this master budget. Now keep in mind the master budget is a static budget. That is, it's at one level of activities that was established in the sales budget. If we have a favorable variance, that means we did better than the budget. Unfavorable, the opposite. Now, the limitations here using the static budget is that it's very rigid. So therefore, management develops a flexible budget, which will adjust the actual volume. To develop a flexible budget is not difficult. The fixed costs will be the same because they're fixed at whatever level of activity. But the total variable cost would be the variable rate per unit times the actual number of units produced or sold. Now, the flexible budget variance will therefore equal what we actually achieve versus the flexible amount that we estimated. And here we produce two types of variances, efficiency and price, or another way of saying it is price variance and usage variance. Now, the price and efficiency variances are what are referred to as input variances. They were the differences of the inputs that went into the production. Now we look at the output, the sales variance. And here we look at the price, the actual price minus the budgeted price times the actual units. Here we have a volume variance, the actual units minus the budgeted times the budgeted price. Now, we can also compare actual results to our standard cost if we have a standard costing system. And here we look at the input variances, and we have price rate variances. That is the actual price minus the standard times the actual quantity. We also have efficiency or usage variance, and that is the actual quantity minus the standard for the output we achieved times the standard rate. Here we also have what are called overhead variance. That is variances in overhead. And we look at the spending variance, and the volume variance. Well, here, just know what they are. You will never be asked to calculate it. Another variance that you should be familiar with is the sales mix variance. Here we're looking at the impact of the actual versus the budgeted product mix on the contribution margin. Now, you will not be asked to calculate it. You just must know what we're talking about. Yield variance is the output versus the input. And when we evaluate the variances, well, the management by exception rule here applies. That means we're only going to investigate those variances that are large, but in our language, we say they are material. In this course, we'll also talk about why we use standard costs. Well, we do that because it provides us an ability to benchmark for control, for pricing, and to increase motivation. Next in this course, we examine responsibility centers. So you should know the difference. There are four of them: cost center, a revenue center, a profit center, and an investment center. Here we evaluate performance using the contribution margin. Why? Well, because the contribution margin does not include any fixed cost. It's sales minus the variable cost. Management should not be held accountable for fixed costs. Fixed costs are the responsibility of senior management. We're talking here about middle line management, managers of different segments. So use the contribution margin here. And if we have to develop an income statement, well, we look at the fixed costs and we get the traceable fixed costs of that division and the allocated fixed costs. Now, a manager may be responsible for some of the traceable fixed costs, but certainly not the allocated. Now, when we talk about segments, we could be talking about product lines, but we could also be talking about geographical centers or different types of customers and so on. When we talk about common cost allocation, here we have to be careful because this is very arbitrary. And two people looking at it can come up with two different ways of allocating. So just be careful with any allocated costs. Transfer pricing issues will certainly be on the exam because we're living in a very multi-corporate world, multinational corporate world. And here we want to provide a system that would promote goal congruence, would be fair in evaluation, would motivate employees, but also different countries have different tax rates, so we want to minimize the tax effect. Now, there are many issues to examine with transfer pricing, and we will do that in greater depth later in this course. But right now, you should be aware of the different methods of doing transfer pricing: the market method, the variable cost method, the full cost method, the negotiated method, and the dual rate method. Know the pros and cons for each one of these methods. Know about these multinational issues. Not only taxes now, we have tariffs and restrictions, and they all contribute to distorting the evaluation of the performance of a segment in the multinational world. Keep in mind that in all cases, the performance measurements that we adopt must align with our strategy, must be timely, and provide feedback on all issues. The challenge here in developing performance measurements, of course, as I mentioned before, is allocation. That's a big thing. Also, if we're going to measure ROI, what are we going to evaluate the assets on? All right. So therefore, ROI is an operation income divided by investments. It's better to use RI, residual income. RI stands for residual income, and that is we're taking the investment times the capital cost rate, and we're going to look at whether that income exceeds that benchmark. And that's what's referred to as residual income. Also, we will discuss the balanced scorecard. That's Kaplan's model, which looks at 4 different perspectives. And you should know them: financial, customer, internal processes, as well as the learning and growth of all the employees. And of course, that leads into the strategy map, which is a visible presentation of the balanced scorecard. You will never be asked to calculate or do anything with a strategy map, but just know it exists. And that covers the main key issues. We go in greater depth in this course as we proceed.